Welcome to session 4, Cost Analysis and Management. The outline of the session is given here. Management accounting versus financial accounting, common cost classifications, cost determination, cost systems, activity-based costing, cost volume profit analysis, contribution margin analysis, strategic cost management, frugal innovation. Managers often ask questions like this: how much did it cost to make a certain product last period? How much will it cost to make the same product next period? What will be the effect of a 10% increase in production cost, revenues and profit? Should we accept a large order from a customer who wants a special discount? How profitable are the 3 products of the firm? What is the budgeted revenue and profit for the next period? What are the principal cost drivers of the firm? Where can we achieve greatest cost efficiencies? To answer questions of the kind raised just now, there is a discipline called management accounting. Management accounting is concerned with providing information useful to managers for planning, decision making and control. It is a vast area which covers topics like product costing, decision making, budgeting, cost management and so on. We have already covered budgeting in a previous session. In this session, we look at product costing, decision making, cost management. In addition, we'll examine issues in innovation management, as innovation has become very essential for many businesses. Let us understand the key differences between management accounting and financial accounting. The primary thrust of management accounting is to provide information required for planning, decision making and control by managers of all departments. The primary focus of financial accounting is to provide information to investors, government agencies and to managers. Time focused management accounting largely has a future orientation. Financial accounting primarily has a past orientation. Time span of reports. Management accounting reports may be prepared very frequently. Sometimes hourly reports are prepared, and in some cases projections may extend forward to 10 years. As far as financial accounting is concerned, the time span of reports is defined by external regulation. It is less flexible. Once in a year, the annual report has to be prepared. Once in a quarter, the quarterly report has to be prepared. Types of reports. For management accounting purposes, detailed reports on products, departments and territories are prepared. As far as financial accounting is concerned, a summary report is prepared primarily for the entity as a whole. Freedom in choice of accounting measures. There are no constraints applicable to management accounting. Financial accounting is constrained by generally accepted accounting principles. Behavioral implications in selecting accounting measures. Choice should consider how measurements and reports influence managerial behavior. Choice is based on how to measure and communicate economic phenomena. Influence of other functional areas. Field is less sharply defined. Heavier use of economics, decision sciences and behavioral sciences. Field is more sharply defined. Lighter use of related disciplines. Overall, we find that management accounting is not constrained in any way, and the reports that are prepared in organization have to suit the needs of managers. The reports have to serve their needs for planning, decision making and control. Financial accounting is primarily concerned with external reporting. Cost determination is an important facet of management accounting. In cost determination, the first thing that we have to identify is the cost object. The cost object can be a product such as an 800cc diesel car, or service such as an air journey from Chennai to Delhi, or program such as a 1 week top management executive development program, or department such as the purchase department of a company, or customer such as all vehicles purchased by MSRTC from Tata Motors. Cost may be classified in many ways. 1. Relationship to the cost object. Direct cost is a cost which can be economically traced to a given cost object. Indirect cost is a cost which cannot be economically traced to a given cost object. 2. Cost behavior pattern. Variable cost is a cost which varies proportionally with the volume produced. Fixed cost is a cost which remains more or less unchanged, at least over the relevant range of output. 3. Manufacturing cost. Direct materials are materials which can be directly traced to a given cost object or product. Direct labor is labor which can be directly traced to a given cost object or product. Factory overhead consists of costs which are not covered under direct material and direct labor. 4. Non-manufacturing costs. Non-manufacturing costs have assumed tremendous significance in recent decades. The important components of non-manufacturing costs are selling and distribution costs, research and development costs, administrative costs, financial costs. 5. Service costs. Services have acquired great significance in Indian economy. The important components of service costs are service labor, materials and supplies, occupancy costs, technology costs, and other service overheads. 6. Timing of recognition. Eventually, all costs are expense. Some costs which are not expense immediately are referred to as inventoriable costs. They are represented in the form of inventories on the balance sheet till the goods are sold. Such costs are also referred to as product costs. Costs which are non-inventoriable are referred to as period costs. They are expense during the period in which they are incurred. 7. Decision analysis. From the point of view of decision making, relevant costs are costs which differ between the two alternatives in future. Sunk costs are costs which have been incurred in the past and are totally irrelevant for present decision making. Opportunity costs are costs of benefits foregone by giving up the best available opportunity. Sometimes people have a misconception that all variable costs are direct in nature and fixed costs are indirect in nature. That is not true. A fixed cost can be direct or indirect. Likewise, a variable cost can be direct or indirect. An example of a direct fixed cost is the fixed salary paid to workers employed in production. An example of an indirect fixed cost is the depreciation charge on plant and machinery. An example of a direct variable cost is the cost of steel required for manufacturing a car. An example of an indirect variable cost is the power cost of the factory. The classification of costs as direct costs and indirect costs plays an important role in cost determination. So let us understand this classification a little further. As I said earlier, direct costs are costs which can be economically traced to a given cost object, and indirect costs are costs which cannot be economically traced to a given object, so they are allocated on some reasonable basis. To understand this difference, let us look at an example of a sofa set being manufactured in a furniture factory. The wood required for manufacturing the sofa set is regarded as a direct cost because the wood needed for a particular sofa can be easily traced to that sofa. The salary of the foreman in the workshop, however, cannot be easily traced to each and every sofa that is being manufactured or each and every item of furniture that is being manufactured. So it is allocated on some reasonable basis to a given sofa set. Having understood this distinction, let us look at the 5 steps involved in cost determination. Identify the cost object, As I said, the cost object can be a product or service or program or customer or department. To identify the direct costs, identify costs which can be directly associated with the cost object or which can be economically traced to the cost object. 3. Identify the indirect cost pools. 4. Allocate indirect costs to cost objects on some reasonable basis. 5. Determine the total cost by adding direct and indirect costs. Here is another example to understand the distinction between direct and indirect costs. The cost object is Mercedes C-Class. Direct costs are costs like steel and tire, which can be traced economically to the cost object based on material requisition document. Indirect costs are costs like lease of land, which cannot be traced economically to the cost object because there is no requisition document. So they are allocated on some reasonable basis. There are different product costs for different purposes. The costs incurred in a firm may be arranged as follows: research and development costs, designing costs, production costs, marketing costs, distribution costs, and customer service costs. Product costs for financial statements or inventoriable costs are just production costs. Product costs for reimbursement under government contract would include research and development costs, designing costs, and production costs. It would not include other costs. Product costs for pricing and product mix decisions would include all costs. As mentioned earlier, there are three elements of manufacturing costs: direct material costs, direct labor costs, and manufacturing overhead costs. The sum of direct material costs and direct labor costs is referred to as prime cost. The sum of direct labor costs and manufacturing overheads is referred to as conversion cost. This is how the total cost is built up: direct material plus direct labor plus other direct expense is equal to total direct cost or prime cost plus production overhead is equal to total production cost or total manufacturing cost plus other overhead is equal to total cost. Cost system, there are two basic forms of production, namely job order production and process or continuous production. The cost systems used for them are the job cost system and the process cost system. Job cost system. The job cost system is normally used in industries where individual jobs, lots or batches are identifiable. It is applicable to industries such as shipbuilding, housing, construction, book publication, and manufacture of special purpose machines. In job costing, every job is given a separate identification number and a job cost sheet is created on which all costs relating to that job are recorded. For example, a publication company is considering a job for producing a book titled Guide to Costing. The costs related to this book are noted on this job cost sheet: direct material costs, direct labor costs, and manufacturing overhead. The product involves processing in two departments: printing department and binding department. So direct material costs in printing department are costs relating to paper and ink. Direct material costs in binding department are related to glue and cardboard. Direct labor in printing department, direct labor in binding department, manufacturing overhead in printing department, manufacturing overhead in binding department. All the items are recorded and finally the total job cost is calculated. Here the job is to produce 1000 units of a book titled Guide to Costing, and the total cost for manufacturing 1000 units is 89,000 rupees, and the cost is built up in this manner. Under process cost system, production is viewed as a continuous flow rather than as a series of identifiable jobs or lots. It is applied to industries such as steel, cement, glass, and petrochemicals. Basically, in a process cost system, cost is accumulated by processes or departments rather than by jobs. The unit cost of a process is defined as total cost of the process divided by number of units produced in the process. The total cost of the process consists of direct material, direct labor, and manufacturing overhead. The number of units produced, also called equivalent units, is calculated in the following manner. Number of units completed and transferred to the finished goods section plus ending work in process inventory expressed in terms of equivalent units minus opening work in process inventory expressed in terms of equivalent units. Here is a numerical example. The basic data is given as follows. Beginning work in process 10,000 units, 40% complete. Ending work in process 15,000 units, 60% complete. Completed and transferred to finished goods section 100,000 units. Equivalent units produced is number of units completed and transferred to finished goods section 100,000 plus ending work in process in terms of equivalent units. There are 15,000 work in process units and they are 60% complete. So 15,000 multiplied by 0.6 is 9,000 less beginning inventory in equivalent units 10,000 multiplied by 0.4, it is 4,000. So the equivalent units completed during the period is 100,000 plus 9,000 minus 4,000, it is 105,000. Which system of costing should a firm use? If there are wide differences between individual jobs, lots, batches, the job order cost system is appropriate. If the products are identical, the process cost system is preferable because it is economical and yet accurate. In the intermediate cases where there are some differences among products, jobs, lots, the choice is not very obvious. It depends on considerations of accuracy and cost. If accuracy matters a great deal, job order cost system is relevant. If the cost of maintaining the costing system matters a great deal, process cost system is appropriate. Examples of job costing and process costing in the service, merchandising, and manufacturing sectors. In the services sector, job costing is used for audit engagements done by PwC, consulting engagements done by McKinsey and Company, advertising agency campaigns run by Ogilvy and Mather, individual legal cases argued by Hale and Dorr, computer repair jobs done by Intel India, movies produced by RK Studios. In the merchandising sector, job costing is used for sending individual items by mail order for special promotion of new products by Shoppers Stop. In the manufacturing sector, job costing is used for assembly of individual aircraft by Boeing for construction of ships at Moscow Dock. In the services sector, process costing is used by Bank of America for bank check clearing, by Indian Postal Service for postal delivery. In the merchandising sector, process costing is used for grain dealing and lumber dealing. In the manufacturing sector, process costing is used for oil refining by Indian Oil, beverage production by PepsiCo. Service sector, accountants in manufacturing organizations developed many of the basic ideas of management accounting. These ideas, however, have evolved and accountants now apply them to all organizations, including service and non-profit organizations. Managers and accountants in service companies, whether profit-seeking or non-profit organizations, have much in common. They raise and spend money, they prepare budgets and design and implement control systems. They have an obligation to use resources wisely. The common characteristics of service organizations are: 1. Labor is a major component of cost. 2. Service organizations cannot store their major inputs or outputs. 3. Output is usually difficult to measure. It is very difficult to measure the output of a service organization. Standard costing: in the early stages of cost accounting, historical costing was used for ascertaining costs and for planning and control. This kind of costing has two drawbacks. One, cost data becomes available rather late for planning and decision making. And two, past actuals without a yardstick for comparison are not very useful for control purposes. To redress these limitations, standard costing was developed. Under a system of standard costing, standards are developed for various elements of manufacturing costs, namely material, labor, and overhead. Actual costs are compared with standard costs and variances are determined, and variances are analyzed for their causes to identify corrective action. To understand standard costing and variance analysis, let us look at an example. The standard and actual cost data for modern electronics companies given below. Standard cost: materials 2 units at rupees 200 per unit, rupees 400. Labor 4 hours at rupees 25 per hour, rupees 100. Overhead rupees 300 per unit, rupees 300. Standard cost per unit is 800. Actual cost data is given here. Materials used 1100 units. Materials purchased 1200 units at rupees 220. Labor used 2500 hours at rupees 24. Overhead cost 200,000. Other information: budgeted volume 500 units, actual volume produced 600 units. Based on that data, we can calculate material variances, labor variances, overhead variances. To understand the nature of variance analysis, we'll focus only on material variances. To calculate material variances, we require data on budgeted volume, standard quantity, actual quantity, standard price, and actual price. Based on the data provided earlier, we find that the budgeted volume is 500 units, actual volume is 600 units, standard quantity is 1200. Standard quantity is actual volume multiplied by number of units of raw material required per unit of the product. In the cost sheet, we found that the number of units required per unit of the product is 2. Actual volume is 600, so standard quantity is 1200. Actual quantity used is 1100. Standard price is rupees 200 per unit of raw material. Actual price is rupees 220. Based on this data, the material cost variance, which is the difference between the standard cost of material for the output during the period and the actual cost of material, can be calculated. The formula for material cost variance is standard quantity for the output multiplied by standard price minus actual quantity multiplied by actual price. The calculation is shown here. Material cost variance is 1200. 1200 is the standard quantity for the output produced times standard price, which is rupees 200, minus actual quantity 1100 times actual price, which is rupees 220. So we find that the material cost variance is an adverse variance of 2000. Material cost variance can be broken into two components: material price variance and material usage variance. Material price variance is defined as standard unit price minus actual unit price into actual quantity. Material price variance is calculated here. Standard unit price is rupees 200, actual unit price is rupees 220, actual quantity is 1100. So material price variance is a negative variance of 22,000. Material usage variance is standard quantity minus actual quantity into standard price. Material usage variance is calculated here. Standard quantity is 1200 units, actual quantity is 1100 units, standard price is rupees 200. So material usage variance is a favorable variance of rupees 20,000. So we find that overall there is an adverse variation of 2,000. This can be explained in terms of two components. There is a favorable material usage variance of 20,000. There is an unfavorable material price variance of 22,000. So overall, there is an adverse variation of 2,000. Designed initially as a tool of cost control, standard costing has been found useful for several interrelated purposes. 1. Control over cost. 2. Costing of inventories. 3. Planning and budgeting. And 4. Pricing of present or prospective products. In the traditional cost system, direct material cost and direct labor costs are directly traced to the products. Overhead costs are collected in a single pool and allocated to products on some plausible basis such as direct labor hours, direct material cost, or prime cost. In the last few decades, the proportion of overhead costs has increased significantly and product diversity too has increased dramatically. In the wake of these developments, the traditional cost system is regarded by many as a very crude system of costing. In order to cope with this phenomena, activity-based cost system has been developed. In activity-based cost system, while direct material cost and direct labor costs are directly traced to the products as they are done in the traditional cost system, overhead costs are broken into different subpools. For example, overhead costs may be broken into three subpools: machining activity costs, assembly activity costs, quality inspection activity costs. And these costs are allocated to various products on different basis. For example, machining activity costs are allocated on the basis of machine hours. Assembly activity costs are allocated on the basis of number of parts in the product. Quality inspection activity costs are allocated on the basis of number of inspections required. Activity-based costing is definitely a refinement and improvement over traditional cost system. Activity-based costing refines a costing system by identifying individual activities as the fundamental cost objects. These individual activities may be designing products, setting up machines, operating machines, and distributing products. ABC system identifies activities in all functions of the value chains, calculates costs of individual activities, and assigns costs to cost objects. Here is a pictorial diagram of how it is done. Cost objects are activities, costs of activities are measured, and then they are assigned to other cost objects such as products, services, and customers. There are three compelling reasons for refining the costing system. One, increase in product diversity. There is a growing demand for customized products, hence product diversity has increased considerably in recent years. Two, increase in indirect cost. The extensive use of product and process technologies such as computer integrated manufacturing and flexible manufacturing systems have led to a sharp increase in indirect costs relative to direct costs. 3. Greater competition in product markets. This calls for more accurate pricing and product decisions, which are very critical to success in a competitive environment. All this requires a more refined system of costing. Activity-based management is a logical sequel to activity-based costing. Activity-based management is a method of management decision making that uses activity-based costing information to improve customer satisfaction and profitability. Activity-based management broadly includes decisions about pricing and product mix, cost reduction, process improvement, and product and process design. The usage of ABC in India has increased over a period of time. Here are the results of a recent survey which shows the usage of ABC by different industries. In manufacturing sector, it is close to 45%. In ICT sector, it is close to 50%. In banking and financial services, it is over 70%. In other services, it is 65 to 68%. So we find that the usage has increased, particularly in the services area. For purpose of planning, it is helpful to analyze the behavioral cost in relation to volume. In this context, three types of cost patterns may be distinguished: fixed cost, variable cost, and semi-variable cost. Fixed costs behave in this manner. Total fixed costs remain unchanged irrespective of quantity produced and sold. It is somewhat unrealistic to assume that total fixed cost will remain unchanged over a wide range of quantity. However, for practical purposes, we may assume that total fixed costs remain unchanged within a relevant range of quantity. Unit fixed cost would decline as quantity increases because the same total fixed cost is divided by more and more units as quantity produced increases. Variable costs are costs which vary with output. Total variable costs are proportionally related to quantity. The relationship that is normally assumed is linear, as shown in this graph. Unit variable cost, however, remains unchanged irrespective of what the quantity is. Semi-variable costs are a combination of fixed costs and variable costs. There are different patterns of semi-variable costs. Some of the commonly encountered patterns are shown in these diagrams. Here, the cost has a fixed element and a variable element as shown by this line. Here, the cost is fixed up to a certain point and thereafter it rises linearly with quantity. Here, the cost behaves in a stepwise fashion with respect to quantity. Here the cost varies linearly with quantity. However, the slope of the relationship changes. There are two segments here. In this segment, the slope is steeper. In this segment, the slope is milder. Cost volume profit analysis or CVP analysis is an important tool of planning and decision making. Cost volume profit analysis is a study of the effects on future profit of changes in fixed cost, variable cost, sales quantity, and mix. A very important question in business planning is, at what level of output will the firm break even? The break even point is the point at which the firm neither makes profit nor incurs losses. To understand how break even point is calculated, let us look at the example of Smooth Flow Company, a firm which manufactures ballpoint pens. The fixed cost of the company are 200,000 rupees. Unit selling price is 15 rupees. Unit variable cost is 10 rupees. Given this information, we have a diagram showing how fixed costs, variable costs, total costs, and total revenues behave with respect to quantity. Fixed costs remain unchanged irrespective of what happens to quantity. Total variable costs vary proportionally with quantity. Total costs are a summation of total variable costs and fixed costs. Total revenues vary proportionally with quantity. The slope of the total revenues line is higher than the slope of the total variable cost line because unit selling price is 15 rupees whereas unit variable cost is 10 rupees. The point at which the firm breaks even is 40,000 units. This is the loss region, this is the profit region. We can calculate the break-even point using algebraic analysis. For that, we set up a very simple equation. Profit is equal to quantity multiplied by selling price minus variable cost minus fixed cost. If we set profit equal to 0 in this equation, quantity is equal to fixed cost divided by unit selling price minus unit variable cost. All I have done is I have set profit equal to 0 and solve this equation for Q. Hence, Q is equal to 200,000 rupees divided by 5 rupees, which is a unit contribution margin. Q works out to 40,000 units. Break-even sales in rupees is simply unit selling price multiplied by break-even quantity. In this case, unit selling price is 15 rupees, break-even quantity is 40,000 units, so break-even sales are 600,000 rupees, and you can see why it breaks even at a sales level of rupees 600,000. When the sales are 600,000, the total costs are also 600,000, fixed costs are 200,000, variable costs are 400,000, 40,000 multiplied by 10. What quantity is required to achieve a target profit? Suppose the target level of profit pi t is set equal to 180,000 by the smooth flow company. The required quantity is obtained by solving the CVP model. On the left hand side is the target profit of 180,000. This is set equal to 15, which is unit selling price, times Q quantity minus 10, which is unit variable cost, times quantity minus fixed cost, which is 200,000. Solving this equation, we get Q equal to 76,000 units. It may be more convenient to use the following equation to get the target quantity. Q is equal to target profit plus fixed cost divided by unit contribution margin, which is defined as unit selling price minus unit variable cost. Target profit 180,000, fixed cost 200,000 divided by 10 minus 5. This also gives the same value of 76,000 units. Break-even sales in rupees. Break-even sales in rupees is simply break-even quantity multiplied by unit selling price. The following equation may be employed to calculate the break-even sales in rupees. Break-even sales in rupees is equal to fixed cost divided by 1 minus V by P, where V is unit variable cost and P is unit selling price. Applying the above equation to the smooth flow company, we get 200,000 divided by 1 minus 10 by 15. This works out to rupees 600,000. This is the level of break-even sales that we had established earlier. In CVP analysis, we commonly use the following terms: variable cost percentage. This is defined as variable cost per unit divided by sales price per unit. Contribution margin percentage. This is defined as contribution margin per unit divided by sales price per unit. Contribution margin is a term used for either total contribution margin or unit contribution margin or contribution margin percentage. When we are talking about contribution, I am reminded of a very interesting experience of mine years ago. I was sitting with the General Manager of State Bank of India at a time when he was interviewing the three directors of a private limited company. Two of them were brothers and the third director was their mother. The firm had been founded by their late father. He asked the first brother what was his contribution to the firm. He said, I'm an engineer. I look after purchases and production. He asked the second brother what was his contribution to the firm. He said, I'm a chartered accountant and I look after marketing and finance. The general manager turned to the lady and asked what was her contribution to the firm. For a while, she didn't understand what he was asking, and then she blurted out, I have contributed the entire management. What information is relevant for decision making? Costs and revenues that are expected to differ between the alternatives in future only are relevant for decision making. This point needs to be emphasized. What matters is what differs between the alternatives in future. In other words, we have to employ the differential analysis model shown below, which is an extension of the CVP model. In this table, we have status quo showing what the situation would be if no changes made whatsoever. Revenue RO, variable cost VO, contribution RO minus VO, fixed cost FO, operating profit PIO. The company is contemplating an alternative course of action. If it chooses the alternative course of action, this would be the profile of revenue, cost and profit, R1, revenue, variable cost V1, contribution R1 minus V1, fixed cost F1, operating profit Pi1. The difference between the two is noted in this column. Del R is the difference between R1 and RO. Del V is the difference between V1 and VO. Del R minus del V is the difference between this and this. Del F is the difference between F1 and FO. And del pi is the difference between pi1 and pi0. What differs between the two in future is noted in this column. This alone matters for decision making. To do differential analysis, it is helpful to prepare the profit loss statement in the contribution margin format. This is the standard format used for profit and loss statement. Sales 3,200, cost of goods sold 2,400, gross profit 800, selling expenses 350, administration and finance expenses 240, profit before tax 210, income tax 60, profit after tax 150. This statement is now cast in the contribution margin format. Sales 3,200. Costs are broken down into two broad categories: variable costs and fixed costs. Cost of goods sold 2,400 is split between variable cost of goods sold, which is 1,600, and fixed cost of goods sold, which is 800. Selling expenses of 350 are broken into variable selling expenses of 150 and fixed selling expenses of 200. Similarly, administration and finance expenses of 240 are split between variable administration finance expense 40 and fixed administration finance expense 200. Once we have done that, we know the total variable cost. They add up to 1790. Sales less total variable cost is contribution margin, which is 1410. Fixed costs add up to 1200. So profit before tax is contribution margin minus fixed cost. Income tax is 60 and profit after tax is 150. Doing analysis of this kind is extremely helpful for decision making, as we can shortly see. Let us apply differential analysis to a firm which is considering the possibility of dropping a product. This is the income statement of a firm which has three products: BIPs, NIPs and DIPs. Sales, variable cost, total contribution margin, less fixed cost allocation, operating profit or loss for all the three products is calculated. The total picture is like this. Total sales rupees 5.5 million, variable cost rupees 3.87 million, total contribution margin 1.63 million, total fixed cost 1.1 million, operating profit 530,000. The sales of BIPs, NIPs and DIPs are rupees 3 million, rupees 1.6 million and rupees 900,000. The fixed costs are allocated to various products on the basis of revenue. So BIPs, which has a revenue of 3 million, will receive a higher allocation of fixed costs. Since fixed costs are 20% of total revenues, the formula for allocating fixed cost to various products is 20% of the revenue generated by the products. When we look at BIPs, variable costs are 1,920,000, contribution margin is 1.08 million. So it will have to bear 600,000 as fixed cost allocation, 20% of 3 million. Operating profit is 480,000. This is the picture for NIPS and this is the picture for DIPS. Someone has argued internally that DIPS is showing a loss of 30,000, so it is a candidate to be dropped. How do we analyze a situation like this? We have to look at differential analysis. Here is how differential analysis is done. The status quo is replication of this picture. Now we ask what happens when dips is dropped. When dips is dropped, sales will decline by 900,000 because revenues generated by dips will be lost. Variable costs will reduce by 750,000 because these are variable costs associated with dips. So variable costs which are 3.87 million will become 3.12 million. Total contribution margin will be 1.48 million. Fixed costs will remain at 1.1 million. So operating profit will be 380,000. Now this is the status quo. If we compare this alternative with the status quo, we find that the difference is as shown in this column. Revenues will decline by 900,000, variable cost will decline by 750,000, total contribution margin will decline by 150,000. So operating profit will decline by 150,000. Thus, we find that dropping dips leads to a decline in an operating profit of 150,000. This happens because dips is making a contribution of 150,000 and that contribution will disappear if dips is dropped. Remember, total fixed costs of 1.1 million remain irrespective of the dips is dropped or continued. So differential analysis suggests that it is not worthwhile to drop dips. Apart from such quantitative analysis, we look at qualitative considerations. The key qualitative considerations in a situation like this are listed here. What is the relationship between dips and other products? Does it have a complementary relationship or a competitive relationship? If it has a complementary relationship, it facilitates and augments the revenues of other products. So the case for continuing with dips gets further strengthened. If it has a competitive relationship, then dips probably cuts into the revenues of other products, and if dips is dropped, that negative impact will be saved. What will be the impact of this decision on the image of the firm? Some managements are very keen on carrying the entire product line, so they would not like to truncate the product line. What will be the effect on motivation of employees? It might be dampening on the motivation and morale of the employees. What is the value of resources that would be released when DIPS is discontinued? There are certain resources which are likely to be released if DIPS is discontinued. What is the value of those resources? One has to look at qualitative factors along with quantitative analysis and take a balanced view. Premier company is wondering whether it should accept or reject a special order. The profit and loss account of Premier Company currently is shown here. This is cast in the contribution margin format. Says 1 million at rupees 50. So total says 50 million. Variable costs are rupees 32.5 per unit. Manufacturing variable costs. So total variable manufacturing costs are 32.5 million. Selling and administration variable costs are 2.5 million. Total variable costs are 35 million. Contribution margin is the difference between 50 million and 35 million. So it is 15 million. Fixed costs are manufacturing fixed costs 6 million. Selling and administration fixed costs 4 million. Total fixed costs 10 million. Operating margin is the difference between 15 million and 10 million, which is 5 million. A customer has placed a special order for 100,000 units provided it can be supplied at rupees 35. The management of the firm has looked at its cost structure and it has found that servicing that special order will entail only variable manufacturing costs. No other cost will be incurred other than variable manufacturing costs. So they have done a differential analysis which is shown in this table. This is the status quo. This is a replication of this. If the special order is accepted, revenues will go up by 3.5 million, 100,000 units at 35 rupees a unit. So revenues will go up by 3.5 million. Difference is 3.5 million. Manufacturing variable costs will go up by 3.25 million, 100,000 units multiplied by 32.5. So manufacturing variable cost will go up by 3.25 million. Selling variable cost, however, will remain unchanged. So total variable cost will increase by 3.25 million. Hence, the difference is noted here. Fixed costs remain unchanged. So operating profit will increase by 250,000. You have incremental revenue of 3.5 million, incremental manufacturing variable cost of 3.25 million. So operating profit will increase by 250,000. Prima facie, it seems that the order may be accepted. However, one has to examine several other factors. What would be the impact of accepting this order on regular sales? What is the possibility that similar requests will arise from others? What will happen to plant and machinery as more and more such orders are accepted? Obviously, they will suffer more wear and tear and depreciate faster, so they will have to be replaced earlier. Eventually, all costs are variable. We are now looking at costs as variable costs only from a short-term point of view, but one should also take a long-term point of view and recognize that in the long run, all costs are variable. Strategic cost management. John K. Shank and Vijay Govindarajan have written an interesting book titled Strategic Cost Management, the new tool for competitive advantage. We'll look at the key ideas in the book. Strategic cost management emerges from a blending of three underlying themes, each taken from the strategic management literature: value chain analysis, strategic positioning analysis, cost driver analysis. Each represents a stream of research and analysis in which cost information is cast in a light very different from that which is viewed in conventional management accounting. The value chain analysis in the strategic cost management framework, managing costs effectively requires a broader focus external to the firm. Porter calls this focus the value chain, a concept that we discussed earlier. The value chain for any firm in any business is a linked set of value creating activities all the way from basic raw material sources for component suppliers through to the ultimate end use of product delivered into the final consumer's hands. As we have learned, the key parts of the value chain are research and development, design of products and processes, production, marketing, distribution, customer service. These activities in the value chain are supported by administration, which includes HR, IT, and finance. Here is an illustrative value chain for a cola bottling company, suppliers of cola concentrate ingredients, manufacturer of concentrate, bottling company where production activity takes place, distribution company, retail company, and final consumer. The importance of costing and budgeting depends on the primary strategic emphasis of the firm. The primary strategic emphasis of the firm may be on product differentiation or cost leadership. The role of engineering product cost in assessing performance is not very important under product differentiation, but very important under cost leadership. Importance of flexible budgeting is moderate to low under product differentiation, but high to very high under cost leadership. Importance of meeting budgets is moderate to low under product differentiation, high to very high under cost leadership. Importance of marketing cost analysis is critical to success under product differentiation, but often not done on a formal basis under cost leadership. Importance of product cost as an input to pricing is low under product differentiation, but high under cost leadership. Importance of competitor analysis is low under product differentiation, but high under cost leadership. Cost drivers, the key cost drivers associated with various business functions in the value chain are shown in this table. Business function, research and development, cost drivers, number of research projects, personnel hours on a project, technical complexity of projects, business function, design of products, services and processes, cost drivers, number of products in design, number of parts per product, number of engineering hours, business function, production, cost drivers, number of units produced, direct manufacturing labor cost, number of setups, number of engineering changes ordered, business function, marketing, cost drivers, number of advertisement runs, number of sales personnel, sales dollars, business function, distribution, cost drivers, number of items distributed, number of customers, weight of items distributed, business function, customer service, cost drivers, number of service calls, number of products serviced, hours spent servicing products. Here is another useful perspective on cost drivers. There are two kinds of cost drivers: structural cost drivers and executional cost drivers. Structural cost drivers are scale, scope, technology, complexity of offerings. Executional cost drivers are workforce involvement, total quality management, capacity utilization, plant layout efficiencies, value chain linkages, product configuration. The important tools of cost analysis in management are life cycle costing, target costing, cost of quality, Six Sigma, lean, value engineering. We will discuss them in some detail. Life cycle costing. Life cycle costs are all the costs associated with the product during its entire life cycle. Life cycle costing is defined by CAM1 as the accumulation of costs for activities that occur over the entire life cycle of a product from inception to abandonment by the manufacturer and the customer. The bulk of the costs are locked in at the research, planning and design stage, so a great deal of care and circumspection needs to be exercised at these stages. Here is a graphical portrayal of how life cycle costs are related to various stages of the life cycle. From this graph, it is fairly clear that research, planning and design contribute the highest percentage of life cycle costs. This means every organization has to spend a lot of time, effort and energy in these stages because they have a very significant bearing on life cycle costs. Target costing. A target cost is a market-based cost. It is derived from a sales price necessary to capture a predetermined market share. The conventional approach to setting price is this: the target price of a product is equal to cost of making the product plus the desired profit margin. Japanese have inverted this. According to them, the target cost should be equal to sales price necessary to get the target market share minus desired profit margin. Target costing is central to Japanese cost management. It has been expressed most vividly by Akio Morita, chairman of Sony Corporation, in his fascinating book Made in Japan. He wrote, "I dictated the selling price of the Walkman to suit a young person's pocketbook. Even before we made the first machine, I said I want the first models to retail for no more than 30,000 yens. The accountants protested, but I persisted. I told them that I was confident we would be making out the new product in very large numbers and our costs would come down as volumes climbed, and that is what precisely happened." Juran has proposed a framework for cost of quality analysis. His framework calls for measuring and monitoring costs in terms of a four-part classification: prevention costs, incurred for preventing bad quality, costs of quality circles, appraisal costs incurred for monitoring the level of bad quality, costs of scrap reporting systems, internal failure costs incurred for fixing bad quality which is discovered before goods are shipped, rework labor costs, external failure costs incurred on account of bad quality that is not discovered before goods are shipped, cost of servicing warranty claims. Quality should be regarded paramount. Enthusiasm for cost reduction should never be at the expense of quality. Catherine Eban, in her book Bottle of Lies, wrote, Randback says manufacturing standards boil down to whatever the company could get away with. By contrast, TV Laboratory focused sharply on quality control and it has become a preferred outsourced manufacturer for Western big pharma companies. For 3 decades, it has had the highest average ROCE in Indian pharma sector. Six Sigma is a collection of tools and techniques for improving operational processes pioneered by Motorola in 1986 and popularized by General Electric. It is widely used in the manufacturing sector. The objective of Six Sigma is to drive down defects to 3.4 per million opportunities. Defects per million opportunities or DPMO is a key metric in Six Sigma. DPMO is defined as number of defects divided by number of units into number of opportunities multiplied by 1 million. Here is an example. An online retailer wanted to examine its order and delivery process. It examined 50 orders and found 11 deliveries were not made in time. On 3 occasions, the order was wrong. In 4 instances, the product was damaged. So, a total of 18 errors or mistakes were made. The company could have made 150 possible errors. So, 18 divided by 150 multiplied by 1 million gives 120,000. In Six Sigma, the effort is to drive down this number to as low as 3.4 per million. Lean. The principles of a lean business often referred to as lean look at operational efficiency from the perspective of the customer. In lean, any expenditure of resources for any reason other than creation of value for the customer, that is something the customer is willing to pay for, is considered wasteful, to be minimized or eliminated. 7 types of waste are considered for elimination or minimization: transportation, motion, inventory, waiting, overproduction, overprocessing, defects. Value engineering, also called value analysis. Value engineering is a systematic approach to a product's design to improve its value, defined as the ratio of functionality to cost. Value can be improved by holding functionality constant while reducing cost, or holding cost constant while increasing functionality. Value engineering examines all the product's elements, namely raw materials, manufacturing process, types of labor and equipment used, the purchased and self-manufactured components, and so on. Vital truths about managing costs. Over the long term, it is essential for a company to be a low-cost producer. For maintaining competitiveness, a company's inflation-adjusted cost of supplying a product or service must trend downward over time. A company must know the true cost and profit picture for each product and market segment and all its key customers. A company must focus on cash flow and balance sheet strengths as much as on profits. Japanese corporations have excelled in cost management. Indeed, Japan's economic resurgence in the 70s was driven by its ability to manufacture high-quality products at low cost, costs that were far lower than those of their Western counterparts. To achieve cost leadership, Japanese firms employed techniques like Kaizen, which is continuous improvement, Kanban, which is a scheduling system for lean manufacturing and just-in-time manufacturing, and just-in-time. Here is a great example of innovation, branding, and cost management. In 2009, Apple's 30 GB iPod had a wholesale price tag of $224. The product was manufactured mostly in China with 424 parts, of which 300 cost 1 cent or less. The display module costing $20 came from Toshiba. China assembled and tested all the parts for just $3.70. Apple claimed to have the largest market share. At that price, the product generated a unit gross profit of $80. Started by the legendary John Bogle, Vanguard Mutual Fund pioneered the idea of index funds. Most of its funds are index funds. It has a unique structure. Vanguard Group Incorporated, the asset management company, provides essential services such as management, investment, and distribution, and it is owned by the funds themselves. It renders these services on a cost basis. There is perfect congruence of interest between investors and fund managers. The fund manager is guided by long-term interest of the clients and not latest investment fads. This structure plus emphasis on indexing plus no commission policy has made it the lowest expense mutual fund in the world. By 2011, Vanguard emerged as the largest mutual fund in the world. Cost management at Infosys. In the wake of the downturn of 2009, Infosys focused sharply on cost management. It converted many indirect cost items to direct cost items and many fixed cost items to variable cost items. The former eliminated non-value adding costs and the latter linked costs to revenues. As Narayan Murthy observed, 2009 helped us build our character by focusing better on customers, controlling costs, and making sacrifices. In the wake of COVID, companies are redesigning cost structures. As the CFO of OYO put it, COVID has forced leaders to take a hard look at their cost structures, identify deep-rooted inefficiencies that have crept in. Concepts of centralization, outsourcing, zero-based budgeting, marginal costing, and fundamental economics have acquired new meaning. It has put razor-sharp focus on the use of technology and automation. Let us sum up the key principles of total cost management. 1. Subscribe to total quality management. By doing it right in the first time, the cost of poor quality reflected in cost of inspection, scrap, rework, and customer dissatisfaction will almost disappear. 2. Focus on the entire value chain. 3. Benchmark against the best. By benchmarking against the best in India and abroad, you have the motivation to improve yourself continually. 4. Rely on activity-based costing. Activity-based costing provides a refined understanding of cost structure and provides clues on improving cost efficiencies. 5. Stretch your brands. Brand equity is a very powerful tool, and if it is leveraged properly, it can reduce cost. For example, SKB, producer of Horlicks and Boost, started manufacturing biscuits, and the biscuits business benefited from the brand equity of Horlicks and Boost. Similarly, Amul initially started selling milk and subsequently began to manufacture milk powder and cheese, and these two products leverage on the solid brand equity of Amul. 7. Rationalize your distribution and service structure. Costs tend to cascade the moment goods leave the factory. Nearly 40% of costs are incurred in marketing and distribution, so these costs need to be rationalized. 7. Use Infotech to cut costs. Many organizations have used Infotech successfully to cut costs. 8. Understand your cost drivers. Understand the structural cost drivers and executional cost drivers and identify areas where improvements can be made. 9. Prune non-manufacturing overheads. Non-manufacturing overheads often don't receive the same kind of scrutiny as other costs do because these costs are dear to top management. However, they need to be carefully pruned and rationalized. 10. Apply lean management techniques which have been suggested by Japanese companies. In these days of hyper-competition and disruption, innovation management is as critical or even more critical than cost management. Let us briefly explore some of the ideas in innovation management. Disruptive innovation proposed by Christensen of Harvard, reverse innovation suggested by Govindarajan, frugal innovation highlighted by C.K. Prahlad, and Jugaad developed by Jaideep Prabhu and others. In his classic work, The Innovator's Dilemma, regarded by many as one of the best business books in the last 5 decades, Clayton Christensen of Harvard Business School argues that many companies are obsessed with sustaining technologies. In the process, they ignore or overlook disruptive technologies, which eventually hurt them very badly. Many companies don't realize the speed at which they are moving up market, over satisfying the needs of original customers. They are engaged in a race toward higher performance, higher margin markets. In doing so, they are creating a vacuum at lower price points into which competitors employing disruptive technologies can enter. As Christensen says, corporations are focused on sustaining technologies. Corporations prefer to invest in sustaining technologies, that is, ones that try to improve performance along parameters that existing customers in mainstream markets value. But to really grow, they have to look to technologies and products that are not currently wanted, but for which there may be a market in the future. Preoccupied with sustaining technologies, companies often become vulnerable to disruptors. Here are some examples. Sears lost its way, missing the big trend to discount retailing, which was exploited by Walmart, and Sears also failed to adjust to online retailing. The cheap, less powered off-road motorcycles exported to America by Honda in 1970s paled in comparison with the powerful deluxe road bikes of Harley Davidson. Yet they proved very popular because they appealed to a large number of customers who were price conscious. Cloud computing data storage has given people a cheap alternative to buying expensive servers from firms such as IBM. Mini mill producers that use scrap metal cut into the market served by the big integrated steel mills like Bethlehem Steel. Initially, they started with rebar and then diversified their product mix. Nucor, once a marginal outfit, became the market leader in US steel production. How industry giants can fight back. These are the suggestions of Christensen. 1. Launch their own disruptive innovation. Ask what job the customers need to be done. Segment customers by job. Develop basic low-cost solutions. Example, Procter & Gamble came up with Crest White strips that made teeth whitening at home affordable and easy. To treat the project as a separate unit, having a different business model and different growth expectations. In their highly acclaimed work, Reverse Innovation, Vijay Govindarajan and Chris Trimble have argued very persuasively that global companies will have to take a different approach to innovation, which they call as reverse innovation. Traditionally, global companies followed a strategy of localization. This meant that they watered down the products made for developed markets to serve customers in emerging markets. A better way for global companies is to develop brand new products for emerging markets inside the country where these products are actually used. Govindarajan and Trimble call this as the strategy of reverse innovation. For example, GE developed in China a low-cost portable ultrasound machine for just $15,000 when the US high-end model costs $100,000. GE realized that US doctors could use these low-cost machines where portability and cost mattered. There are two compelling reasons for global companies to adopt the strategy of reverse innovation. One, products built for emerging markets are likely to be well suited for issues that ultimately affect all markets. Two, as emerging market companies grow, they would offer their products in developed markets often at much lower prices. Incumbent firms would find it tough to beat them. So they should practice reverse innovations so that they are not disrupted by low-cost competitors tomorrow. In his book, The Three-Box Solution Strategy for Leading Innovation, Vijay Govindarajan argues that a firm should divide its businesses into three boxes. Box 1, manage the present. Box 2, selectively abandon the past. Box 3, create the future. According to him, firms are preoccupied with box 1 and tend to neglect box 2 and box 3. He believes that firms should focus more time, effort, energy, and initiative in box 2 as well as box 3 in order to deploy resources for creating future innovation. Clayton Christensen coined the term disruptive innovation for new products that slash prices and new processes that radically alter the way goods are made and delivered. Today, many of these disruptive innovations are occurring in emerging markets. They will have a bigger impact in the West than lean production, the last great disruptive management innovation from the East. According to C.K. Prahlad, a management guru, any innovation in India must conform to four key principles. One, it should provide a new price performance envelope so that the products and services are affordable to all. Two, it should be scalable given the size of the country and the market. Three, it should be ecologically sustainable. Four, it must represent world-class quality. Outstanding examples of innovations in India are Jaipur Food, Amul, ITC Chowpal, Arvind Eye Care, and Narayan Rudale. Narayan Rudale Hospital or NH hereafter performs open heart surgery for just $2,000 when it is upward of $20,000 in the US. NH has a net profit margin which is slightly higher than the US average. NH has world-class quality. Mortality rate within 30 days of bypass surgery is 1.4% at NH compared to the US average of 1.9%. NH success is partially explained by India's lower cost of labor. The real magic is in the process innovation. NH took the radical step of adapting a number of well understood industrial concepts which have been around since Ford's Model T. Concepts such as standardization, specialization of labor, economies of scale, and assembly line production. ITC's e-Chopal is another example of Indian innovation plagued with inefficient supply chain in rural agriculture. ITC implemented its e-Chopal initiative in 2000. It set up small internet kiosks in villages that allowed farmers access to an efficient and transparent alternative to the traditional mandi for marketing their produce. It established direct channel between the farmer and itself. It discovered a delicate balance between corporate profitability and social contribution. It extended the e-Chopal framework to deliver core services such as access to healthcare, education, and information. It liaised with other companies, including FMCG companies and finance companies, to deliver products and services to rural India. Gujarat Cooperative Milk Marketing Federation Limited GCMMF, popularly called Amul, is a great example of innovative cost management. Amul is the second largest FMCG company in India, only after Hindustan Unilever. It procures on a daily basis 2.3 crore liters of milk from 18,700 village milk cooperative societies, which include 36 lakh milk producer members. It offers a fair deal to farmers, management team, its 10,000 dealers, its 1 million retailers, and crores of customers. Four factors seem to have contributed to Amul's success. Effective brand management. Amul has successfully cultivated a 60-year-old brand with distinctive imagery, sustained alignment with stakeholders' interests. Amul has provided a fair deal to farmers. This is linked with the idea of disintermediation of the middlemen, political and regulatory buy-in. Korean Verghese, the principal architect of Amul, writes in his autobiography I Too Had a Dream about the visits of political leaders like Patel, Nehru, Shastri, Morarji Desai, TTK, YB Chauhan, Indira Gandhi, and others. He brought them to Anand. They vowed to the scale of Anand and the miracle of Anand, innovation and risk-taking on a consistent basis. Amul is the first organization in the world to use buffalo milk for making skim milk powder and condensed milk with the help of a specially designed machine produced by Larsen and Toubro. Likewise, Amul is the first organization in the world to use buffalo milk for making cheese. Indian Space Research Organisation or ISRO, set up in 1969 with a modest budget of $1 billion as compared to NASA's budget of $40 billion. ISRO is the world's most cost-efficient space program. Its focus has been on communication satellites and weather satellites required for agriculture. Its thrust has been on short-duration projects and simple projects. It has definitely benefited from low-cost engineers and from sourcing of materials and parts from local suppliers. However, what seems to distinguish ISRO from many other Indian organizations are its missionary zeal, meritocracy, well-defined short-term targets. Arvind Eye Care System, headquartered in Madurai with a number of hospitals in Tamil Nadu and adjacent states, is the largest eye care system in the world. It has a business model based on paraskilling to provide affordable eye care to the poor. Paramedics perform all non-critical procedures and specialists do only final diagnosis and surgery. They have been able to achieve an eightfold increase in number of surgeries performed by doctors. Over 4.5 lakh surgeries are done every year, one half of them being free. Arvind Eye Care System is the most efficient and the largest eye care system in the world. Here is a good example of frugal engineering. Most villages in India have power supply for just 9 hours a day and the timing is also erratic. So the conventional refrigerator, which requires a compressor, is not suitable for such conditions. Godrej Industries surveyed villages and found that refrigerator is used primarily to prevent food from spoiling during the day and not for making ice. So they developed a fan-cooled refrigerator which could reduce the temperature to 6 to 7 degrees, which was sufficient to prevent food from spoiling. And such a refrigerator can be supported by battery when there is no power supply. Jugaad Innovation, authored by Navi Raju, Jaideep Prabhu, and Simon Ahuja, is an important contribution to the literature on innovation. Jugaad is a frugal and flexible approach to innovation. In an interesting book titled Jugaad Innovation, Jaideep Prabhu and his co-authors have articulated the principles of Jugaad. According to them, there are 6 principles of Jugaad. 1. Seek opportunity in adversity. 2. Do more with less. 3. Think and act flexibly. 4. Keep it simple. 5. Include the margin. 6. Follow your heart. A word about these principles is in order. 1. Seek opportunity in adversity. Creative people always look for ways and means of overcoming adversity and find opportunities hidden in adverse circumstances. There's an interesting example of this principle. There was a donkey in a village. The donkey strayed outside the village and fell in an open well which was deep and dry. The donkey brayed. Villagers came to see what happened. Villagers tried to rescue the donkey, but they could not because the well was deep. Finally, they went back. The donkey kept on braying for a couple of days, and villagers could not tolerate the braying of the donkey, so they decided collectively to bury the donkey by shoveling mud inside the well. They started shoveling mud. The donkey brayed harder for a while. After some time, the donkey stopped braying, so villagers curiously looked inside the well and they found to their surprise that when they shoveled mud, the donkey shook off the mud from his back and took a step upward. As they shoveled more and more mud, the donkey kept on moving up and finally came out of the well. This is an interesting example of seeking opportunity in adversity. Do more with less. The basic idea of Jugaad is to do more with limited resources. 3. Think and act flexibly. Human beings are quite creative. They can adapt themselves to situations where there are serious constraints. 4. Keep it simple. There's a well-known principle called keep it simple, stupid, or KISS principle. In Jugaad, the process is simple and the product is simple. Jugaad does not believe in complicated processes and complicated products. The whole idea is to simplify, economize. 5. Include the margin. Jugaad innovation is meant to benefit the largest number of people. So such innovations are available inexpensively so that people at the margin can also use those innovative products. 6. Follow your heart. Jugaad is driven by passion, not reason. Jugaad is driven by a deep motivation to do something good for the society, not by intellectual calculus. A great example of Jugaad innovation is Mitti Cool or clay fridge, developed by Mansukh Prajapati in Gujarat. When Gujarat was devastated by earthquake, there was a lot of misery and adversity. Mansukh Prajapati responded to that adversity by developing a clay fridge which he called Mitti Cool. In this clay fridge, water from an upper chamber seeps through the side walls, cooling the lower food chamber through evaporation. This fridge consumes no electricity, is 100% biodegradable, and produces zero waste during its lifetime. Prajapati transformed pottery from an artisanal craft to an industrial process, which led to a product that has now become very popular. The aim of India's National Innovation Council is to create an Indian model of innovation of the people, by the people, and for the people. As Sam Pitroda, its chairman, said, given the sheer scale of our needs in our vast population, our innovation needs to be frugal with scarce resources, affordable for the poorest citizens, and environmentally sustainable. Our strategy is to focus on parameters of sustainability, affordability, durability, quality, global competitiveness, and local need. Honeybee Network, set up by Professor Anil Gupta of IIM Ahmedabad, identifies and cross-pollinates grassroots innovation across India. Honeybee has a database of over 10,000 inventions of grassroots entrepreneurs who have created ingenious solutions for pressing socio-economic problems in their local communities. There are two simple key performance indicators of innovation: innovation pipeline strength and return on innovation investment. Innovation pipeline strength is simply future revenue potential of innovation projects. Suppose a company has 3 innovation projects A, B, C, and the future revenue potentials are 20 million, 40 million, 60 million. Then the innovation pipeline strength is the sum of these three, which is 120 million. Return on innovation investment ROI square is defined as net profit from new product or service divided by innovation cost of the products and services. If the net profit likely from new products and services rupees 5 million and the innovation cost is rupees 4 million, then the ROI square is 1.2. Let us sum up our discussion. Management accounting provides information required by managers for planning, decision making, and control. Costs can be classified along different dimensions. The steps involved in cost determination are A. Identify the cost object, B. Identify the direct cost, C. Identify the indirect cost, D. Allocate indirect costs, and E. Determine the cost as a sum of direct and indirect costs. There are two systems of costing, job cost system and process cost system. Standard costing is widely used for planning, costing and control. Activity-based costing is a refinement over traditional costing. There are three types of cost patterns: fixed costs, variable costs, and semi-variable costs. Cost volume profit analysis is the study of the effects on profit of changes in fixed cost, variable cost, quantity, and mix. Costs and revenues that are expected to differ between the alternatives in future only are relevant for decision making. Strategic cost management has emerged from a blending of three underlying themes: value chain analysis, strategic positioning analysis, and cost driver analysis. Important tools for cost analysis and management are life cycle costing, target costing, cost of quality, Six Sigma, lean, and value engineering. Key ideas in innovation are disruptive innovation, reverse innovation, frugal innovation, and jugaad. Thank you.